All right. Well, good morning, everyone, and welcome to Park City Credit Union's second annual Northwoods Financial Summit. Thank you for taking the time to attend this virtual session. My name is Sarah Sturm. I'm a member of our marketing team here at Park City Credit Union, and I'm excited to be your moderator for this session. Before our presenter, Luke, begins, we have a few housekeeping items to share. During the presentation, we will have all participants in a listen-only mode to reduce any feedback. We will have a Q&A at the end of the session, and at that point, you can unmute yourself to ask your questions. However, feel free to leave your questions in the chat at any point during the presentation, and we can address them when there is time. For those unfamiliar with Webex, we have provided a key on the screen that references a few helpful features. You can mute and unmute yourself by clicking on the microphone icon. Clicking on the chat bubble will bring up the chat box where you can leave your questions and comments for our presenter. Clicking on the person icon will bring up the participants panel. There, you can click the raised hand icon to signal that you'd like to speak and unmute yourself. As a reminder, this session is being recorded. We will send the link to all registered attendees next week when all sessions are completed. Included in that email, we will have a link to a survey for your feedback on the Financial Summit. And as a thank you for filling out the survey, you will be entered to win a prize. I will now introduce our speaker. Luke is a financial wellness expert with GreenPath Financial Wellness. GreenPath is a nonprofit organization with a mission to empower people to lead financially healthy lives. Since 2006, Luke has helped individuals and groups of people learn about budgeting, credit reports, and managing debt. So Luke, with that, I forgot to share the next screen. There we go, there's Luke. I will stop sharing my screen so you can take over, Luke.
Thank you very much, Sarah, and welcome everyone to today's portion of the summit, which is managing, improving, and protecting your credit during COVID-19. So this is a topic it's a very broad topic. So we'll want to take a look at the details of this topic in kind of a higher level and apply it to the specifics of our situation and the specifics of the time that we're in as well. So I'm going to take us through the big picture of credit, how it works, how does credit scoring work, how do we get the information about our credit and about our credit score, and then apply that to some of the current environment that we're in with the COVID-19 pandemic. So we'll take it one step at a time through the process. Some disclaimers before we go. Because this is such a broad topic, I'm going to be teaching the generalities of credit so that you can then apply those details to the specifics of your situation. So to put it succinctly, we're going to learn the basics of credit so you can apply it to the specifics of your credit situation as well as the current climate with COVID-19. So I may not be able to cover every aspect of credit you might be interested in, but we should be able to give you enough that you can apply it to what you want to know and what you want to do with your credit. Now, the importance of understanding this topic is really best illustrated by understanding the areas of life that are impacted by credit reports and scores. So those different areas are financing, when you apply for a car loan, a mortgage, even a credit card. The rate can be, of those items can be impacted by your credit score. Many employment opportunities may require that they actually access your credit report as a security thing before they provide the job to you. So there may be employment opportunities where this is impacted. Utilities may check your credit before providing you the utility, or may ask for a security deposit depending on how your credit looks. And also insurance premiums can be impacted by information on your credit report. So a lot of different financial areas are impacted by our credit. So it's important we know how our credit works and maximize our credit to help us get the best rates and the best costs as we move forward with some of these different areas of our financial situation. Now let's take a step back, understand what credit is first, to understand why credit reports and scores are used in some of the things that we just mentioned. So credit is an agreement wherein you receive goods and services now with the understanding that you'll pay the lender later. So you're getting something now, you're going to pay for it later or pay for it over time. So what lenders want to know is, if I'm going to offer this to you, offer this service to you, give you this money, what's the likelihood you're going to pay me back? And so credit reports and credit scores help give them a gauge of what's the risk of lending to you in many of those scenarios, or doing business with you in those scenarios. So a credit report is something that will compile the information about how you handle credit and debt accounts. So when you pay on your mortgage, when you pay on your car loan, when you pay on the credit card, how are you managing those particular accounts? The credit report is going to compile all that information. And then a credit score is just your credit history, all of those transactions and activities on your credit, just taking all that history and expressing it as a number. So it's compiling it to a number to say good risk or a bad risk, and it allows lenders or businesses to understand what's the appropriate risk level if they lend to you or do business with you. So that's the general concept of credit and why credit reports and scores are around to help simplify the process, make it more efficient, make it cheaper to get credit over time. So instead of someone having to dig into all of your history on how you handle debt and credit accounts, they can simply run your credit score and see, hey, good risk or not a good risk, and then make an appropriate decision based on those particular scenarios. So that's kind of the philosophy behind why credit reports and scores are used so broadly in our economy. Now, there are 3 credit reporting companies, Experian, Equifax, TransUnion. These are the 3 national credit reporting agencies. There are more out there, but these are the 3 main ones that most creditors provide information to and that most lenders use when they pull your credit. So these 3 companies compile information. The information is sent to them by the creditors. They don't control the information itself. They just compile the information. So when you pay on your credit card, that credit card company reports it to maybe Experian, maybe Equifax, maybe TransUnion, maybe all 3 on a monthly basis. And those companies just compile the information and put it into a credit profile for you. So if someone does pull your credit, they see all the different transactions of those accounts provided by the particular creditors that reported that information. So it's important for you as a consumer to review all 3 of your credit reports to make sure you understand what's being reported on those reports and what lenders might see when you apply for something in the future. We'll talk shortly about how to access your credit reports. What information is on the credit report? It's very standard. We'll actually give a few screenshots of some examples of what this could look like, but it's first identifying information. Who are you as a person, so that when information comes into the credit reporting companies, they can put it in the appropriate profile. Second are the credit is the credit and account information, so the different accounts that you have, the credit card, the mortgage, the car loan. It could also show the collection accounts if there was an old debt that got moved over to a collection agency. So it's listing all the specifics of each of those credit accounts and the information that you have there. Third, bankruptcy public records are listed, so if you do have a bankruptcy, that will show on the credit report. And then fourth, inquiries. So this will show how often your credit is pulled, whether by you or by someone else, and whether it's a hard pull or a soft pull. I'll talk about those shortly. So it's how often is your credit being accessed to be reviewed and why it's being reviewed. Information that's not included on your credit report. Income is not listed, assets are not listed, savings are not listed, and there's other things that aren't listed either, like criminal record, those sorts of things. A credit report, again, is just the history of how you manage the credit and debt accounts that you have. So when it comes to understanding how you borrow or how you maximize your credit in a transaction, understand when we talk about credit scores, it's just looking at, again, how you handle those credit and debt accounts. When you apply for a mortgage, they're going to ask you to pull your credit report, so that they're going to take a look at that, but then they're going to want all the other information that's not there. What are the assets that you have? What's your income? What's the stability of your income? What's all your savings? So they're filling out the rest of the picture in addition to the credit report and score. So the credit report and score is just one aspect of your situation. It's historically how you're managing the debt that you have. It's not a complete picture of your financial health or financial wellness. And we'll touch on that a couple times today. So these other things are not included. It's just the credit and debt accounts that are being reported to the credit report. Now, if you've never seen a copy of your credit report, this format here is just a generic, general format. What you see when you actually pull your report could look a little bit different format-wise, but the information is generally the same. So your personal information on a report, what's your name, What's your address? What's your social security number? What's your date of birth? So again, this is just gathering the personal information for you to make sure the information is put under the appropriate credit profile. When you check your credit report, it's important to look at this area of the report to make sure it's accurate. If something is inaccurate, let's say a different social security number is entered, but the rest of the information is the same, or it's your name and social security number, but an address that you don't recognize. These could be indications of identity theft or fraud that you want to investigate. So you'd want to dispute that, look into it, and try and figure out why that information is showing on your report. This information, the personal information, does not affect your score, but again, it is important to review it for security purposes to make sure there's no identity theft that could be occurring. Second section that I mentioned is the credit and account information. So the different trade lines that you have. It's going to tell you who the creditor is, what the address is, either the full account number or portion of the account number to help identify what account it is. It'll tell you what type of account it is. So this could say mortgage. This could say installment. Installment loan is something like a car loan where you pay the same amount each month until it's paid in full. Or it could be revolving, like a credit card where you can charge up on the account, pay it down, charge it up again, pay it down. So it'll tell you the type of account it is. It'll give you different terms of the account, so how long are the payments, what's your minimum monthly payment, those sorts of factors. It'll also look at the ownership of the account. So is it an individual account where it's just you as the person that's responsible for that account, or is it a joint account? Joint would mean there's another person that's responsible, so it's going to show up on your report and then the report of the other person that's responsible. So if you're a co-signer on something, it's going to show up on both credit reports for you and the person for whom you co-sign. So this information is going to just list out the details of each account, including the payment history. So it's going to show, are you paying on time each month? Are you 30 days past due, 60 days past due? It's going to show the information there for that. This information does impact your credit score, and we'll talk about how that plays into that. So it's important to check this section for a couple things. One, do you recognize all the accounts? Are there any accounts here that you don't recognize? Again, if there is something that's not familiar, look into it. Again, it could be someone who's opened an account in your name. But look at the accounts that are familiar to you. Is it reporting correctly? Does it show the proper ownership? Does it show the proper payment history? Make sure that it's tracking all of the payments appropriately that you're making. And generally, most of that's pretty much up to date because it's automated, but always do double check just to make sure that nothing's out of sorts there. So check this section for accuracy, but also just to understand, what debt do you owe? Who do you owe the money to? What's the payment history on that account? Those are all very important things for you to understand. And then third area is inquiries. So this is how often is the credit being accessed, or who's accessing the credit and when. So inquiry is essentially just accessing the report for review. A hard pull or a hard inquiry on your credit is when someone else is reviewing the credit for the purpose of making a decision. So when you apply for a mortgage or a car loan, those are hard pulls because you're asking them to pull your credit so they can review it to see if they're going to offer you that financing or offer you that credit, whatever it may be. Hard pulls can have an impact on your credit score. Typically not a huge impact, but it can have an impact because there's risk involved. If you apply for that loan, apply for that mortgage, you're granted that loan or that mortgage, it means you're not going to be responsible to pay that debt. So if you're applying for a lot of things, that means you're going to be responsible for a lot of things if you're granted that particular credit. So hard pulls do have somewhat of an impact on your credit simply because there's risk involved if you're granted that particular credit. So you want to check this section for accuracy. Again, do you recognize who's accessing your credit? Did you request it? It should be familiar to you if you have. Also, if you're shopping around for credit, so shopping for a car loan, shopping for a mortgage, I don't recommend that. Just go to Park City Credit Union, get the loan through them. But if you're shopping around, do it within a short window, typically within a 30-day window. If you get your credit pulled multiple times for a car loan or for a mortgage, it only shows, or is only counted, I should say, it's only counted as one inquiry instead of multiple. So that allows you to at least compare things, make sure you get the best rate, without negatively impacting your credit significantly. It'll show as one inquiry, typically within a 30 to 45-day window for those types of purchases. So hard inquiries show up. And then there's also soft pulls. So this is where credit's being accessed for a reason that you haven't requested. It is allowed for companies to access your credit for promotional purposes. So they pay for getting that information and soliciting to you to see, if you want to get their loan or credit or whatever it might be. It's also if you were to pull it yourself to review your particular account. Soft pulls, because there's no risk associated with it, because you haven't initiated it, it does not impact your score. But do check this section just for curiosity's sake. It's not going to, again, hurt your score. Just kind of be familiar with how often your credit's being accessed to see what that looks like. Now, to get a copy of your credit report, the best place to go is annualcreditreport.com. As a consumer, you're allowed to get a free credit report every year from each of the 3 national credit bureaus. So through annualcreditreport.com, it's an online way to do that. You can also do this over the phone and through the mail. So through the website, you can get the contact information for doing it those ways as well. One thing I will say, because of the COVID-19 pandemic, the 3 credit bureaus are actually allowing you to get weekly credit reports if you wanted to do that. So normally it's once per year that you're allowed to get access to the reports. Through COVID-19, you can actually get it weekly through the annualcreditreport.com website. So do know that. Why would you want to know that? Well, with COVID-19 going on, when you're requesting forbearances or deferments on accounts, which we'll talk about today, you may want to just check the status of those, how they're showing on the report, make sure everything's documented appropriately. So this allows you to do that with the extra benefit here that the 3 credit bureaus are providing during the pandemic. So through annualcreditreport.com, if you've never done this before, it's very easy to do. You simply go to the site, you fill out a form with the contact information they would need, the personal information I mentioned before, name, date of birth, social security number, recent addresses. It's going to find the appropriate credit profile for you. You pick the reports you want. So you can select all 3 at once, or you could select just one at a time. You can choose how you want to do that, and then click to review the report. There may be some security questions to make sure you're the appropriate person accessing the report. So it may be a question like, in 2014, you took out a car loan with a lender. Who was the lender? And they'll give you multiple choice, and you should be able to select the appropriate one if you're familiar with the transaction that was done. So there may be some security questions there, but once you get through that, the report pops up, and then it's available for 60 days. You can see all the information there, review it. There's also typically within the report places where you can dispute inaccurate information, and they give you instructions on how to dispute that if something is not reporting correctly. So you can actually do it right online if you choose to. So reviewing your report, very simple, easy to do. Do know that it typically does not include the score. If you want to view your credit score, we'll talk about some other ways to do that. But through annualcreditreport.com, you do, as a consumer, have a right to access the information on your report on a regular basis. Now, the information that shows on your report, the length of time that it can stay there can vary depending on the type of information that it is. So open accounts in good standing can be on there indefinitely. So essentially, as long as those are accounts open in good standing, the information will stay there indefinitely. Closed accounts in good standing will typically stay on for up to 10 years. Now, the creditor may choose to end the reporting before that 10-year period, but it could stay on for up to 10 years. Then negative information like later missed payments, collection accounts, that can stay on for 7 years from the date of the original delinquency on that particular account. So that negative information can show for 7 years. Chapter 7 bankruptcy can stay on for 10 years, Chapter 13 bankruptcy for 7 years. And then your inquiries, or the hard pulls or soft pulls, typically there's 2 years of those listed on the report. Now, the moral of the story here, especially when it comes to later missed payments, collection accounts, if you can avoid this negative information from showing on your report, do what you can to avoid it from showing. So if you're coming to a place where you can't make the payment, talk to your creditors. We'll talk about some ways to do that in a minute, but make sure you either get it paid or make sure you get a status put on the account to avoid the late payment or the missed payment. so that the notation doesn't stay in the report. Now, if it does happen, if you can't avoid that, obviously take care of yourself first with food, shelter, clothing, and other priorities in your household. If something derogatory does show on your credit report, it's not the end of the world. You can always rebuild your credit once things get back on track. But if you can avoid it, easily, at least take the initiative to avoid that from showing on the report. Now, credit scores, so the report itself is just, again, the compiling of the information, and we'll see in a minute how this all ties together with credit scoring. Credit scoring, again, is your credit history expressed as a number. So it's a 3-digit number. It shows the likelihood of repayment or the level of risk for a lender. And the most popular type of credit score is the FICO score, which ranges from a low of 300 to a high of 850. There are other scores out there, but they generally follow a similar scoring range. Not exactly, but pretty similar, and also a similar model as far as how the score is weighted. We'll talk about the FICO here in a minute. And the higher the score, the better. So we'll see why that's so important with the scoring model itself. To access your credit score, there are different ways to do it. When you're pulling your report through annualcreditreport.com, they may ask you, do you want to purchase your credit score? Do you want to purchase a credit monitoring service? They'll solicit to you. That's okay if you choose to do that. You can certainly do that. It's not a necessarily expensive thing to do. Many times a single score could be $10, $15, something like that, or you could get all three at once for maybe a larger amount. So you can purchase your score from the credit bureaus if you choose. Through your financial institution, through the credit union, typically when you apply for something, your score is provided, but it's only when you're applying for something. Don't apply just to get your score, but you would be given that score upon applying for something typically. Your credit card providers may provide free credit scores, so if that's a service of your credit card provider, maybe check into that. And there are also apps for your phone or for your tablet. Apps like Credit Sesame, Credit Karma, they give what's called an estimate of your credit score. It's not your exact credit score, but by signing up, it's a free service, but you're essentially logging in to get information about your credit score, but it's also through the app allowing companies to get your information so they can then solicit to you. But these apps could provide a free credit score. You can monitor it through that service if you choose, but do know that you'll be opened up to marketing from the different companies that get that information. Now, do you need to check your credit score? If you're curious, feel free to check your credit score. Take some time to do it if you want to, or pay to do it. You don't necessarily have to know your credit score, though. Why? Because a credit score is just an expression of the history of your accounts that you're managing. So if you're managing your accounts well, you can assume you have a good credit score. So if you know how to read your report, if you know how the score is weighted, you'll know typically if you have a good score or not, before you even look at the credit score. Now, if you're just starting out figuring out where's my baseline for my credit score, it may be helpful just to check your score today and then maybe check it every year, thereon. But it's not something you need to consistently know once you know how credit scoring works. So let's talk about what that looks like. Here are the 5 factors in a FICO credit score, and let's walk through them one by one, why they're so important, and what you need to know to keep that in mind for improving, maintaining, even protecting your credit score. So first is payment history. This is the most important factor in a FICO credit score. This is asking the question that every lender wants to know. If I'm going to give you money, are you going to pay me back? Well, what's the best indication of that? How have you paid back other people? So the payment history on your accounts, paying on time, paying the full amount that you owe, this is the most important factor in your credit score. So make sure that you're doing that. If you're not paying on time, start paying on time and then continue that process. That's going to be very important. Secondly, are the amounts owed, or your debt to credit ratio, or how much you're paying on installment accounts. So this is looking at 2 factors, the amounts owed, this 30%. The debt to credit ratio, so let's say you have a credit card with a $10,000 credit limit and you have a $5,000 balance, well, you have a 50% debt to credit ratio. The higher that ratio it is, the more risky it is. So if you have a $10,000 limit on that credit card and your balance is $9,000, well, that's risky, right? Because you have to pay that money back. The obvious question is, why are you carrying that balance? Why can't you pay it down? So you want to have a low debt-to-credit ratio on your credit cards, typically 30% or lower. Just keep it as low as possible or start paying down those balances. Try to get those ratios down as best you can. And if you're in a position where you can't do it, quickly over time, at least do it consistently over time. Start putting together a plan to stop using the card and start paying down the balance so that ratio improves. The second factor it looks at are the amounts owed on the installment account. So if you have a car loan for, say, $20,000, well, what's the balance today? What was the balance when it was taken out? What's the balance today? That number should be decreasing over time. You should be paying off those installment accounts. So the car loans, the student loans, you actually have to pay those back. So the wider that spread that gets between the original amount and the current amount, the less risk there is there. So just make sure you're consistently paying down those installment accounts. Third factor is the length of credit history. And so this is just a factor of time. How long have you had credit? How long have you managed these in a healthy way? So everything you're doing today is more important than what you did yesterday, but you have to have a track record of that information. So someone that has a 20-year track record managing credit well is going to have a little bit better score than someone that only has a 2-year track record of managing credit well. But the longer, the better that you've been able to manage those particular accounts. Fourth factor is new credit. So this is the hard inquiries, the hard pulls. When you apply for things, this is where it could impact your score. But notice it's such a small percentage. It's only 10% of the score. So don't apply for something if you don't need to. Only apply for it when you need to. And if you do that, you should be okay when it comes to this factor in your credit score. And then the last factor is the types of credit used. So this looks at what types of credit do you have, what's the risk of that debt or that credit that you have. So if I were to say to you, I'm looking at this person's credit report, they have $200,000 of debt. Do you know if that's risky or not? Well, with that information, just that information, you don't really know. But if I said they have $200,000 of debt, but it's all secured by their home, it's their mortgage that they owe that $200,000. Well, that's less risky than if I said, well, they have $200,000 of debt and it's all on credit cards. It's all unsecured debt that they're trying to pay down. So it just this looks at what's the type of debt that you have, what's the risk in it. You don't have to go out and get a mortgage to show that you're less risky in the debt that you have. It's just manage the things that you have well, right? So it's just weighing what are those different types of debt, how are you managing those. Whatever you have, just manage it well. You'll do just fine with the types of credit that are being used on your report. So those are the 5 factors in a score. If you've never seen this before, it may seem very simple, and that's because it is, right? Because again, what's the goal of a credit score? To tell someone the likelihood of repayment or tell someone the likelihood of risk when they lend to you. So when it comes to maintaining and improving a score, the simplicity really bears itself out. So if I were to ask you, how would you improve or maintain a score based on the information that I told you? Well, you just start running down the factors of the credit score. So most important thing you can do to improve or maintain a score, pay all your accounts on time. Pay them in full each month. If you're not able to do that, like I mentioned before, start paying on time, start getting that consistently done, and that'll start improving your score automatically just by taking that first step. Second most important thing you can do is, again, keep your balances low, less than 1/3 of the available credit if possible on those credit cards. And then also keep paying down the balances, both on the revolving accounts as well as the installment account. So those 2 biggest factors that we looked at, payment history, the amounts owed, that accounts for about 65% of your credit score. So if you can do just these 2 things right, in most cases, you're going to see an improvement in your credit. Or if you have a good score already, it's going to help maintain that score that you have. And then third factor, only apply for accounts as needed, right? So the hard inquiries on your credit, don't go out and open 10 credit cards in the same month. That's going to be risky and drop your score. Only do it as you need to. It's not a bad thing if you want to go and get another credit card or get another loan or something like that. Just do it when you need to and be smart about it. These 3 things, take up, again, a large chunk of the factors in credit scoring. Just be smart about it and you'll do just fine with improving and maintaining a score. Some other things to consider if you have old debt on a credit report, so a collection account, maybe a medical collection, something like that, resolve those old debts. Because when they're sitting out there with a balance, it's essentially an obligation and some risk that could be impacting your score. And so lenders want to see that you're able to resolve those. They're not going to be an issue in the future. So if you can pay those down, get those taken care of, that's a great way to improve your credit. And then lastly, establish credit where you need to. So if you have a thin credit history or you're just kind of getting started with credit, establish credit and establish a positive payment history over time. So maybe get a small loan or a credit card just to start paying for things and establishing that credit. You could get a credit card, pay for a tank of gas each month, and then just pay that card in full. That's establishing a credit history. You don't have to pay interest on it. You can pay it in full. You're not taking on any new debt to do it, but it helps establish that history. You could also consider, if you need to, if you have credit but it's just been kind of difficult to get things rebuilt, check out the credit rebuilder loan through the credit union. This may help you establish that payment history, show the positive payments going forward. So there are a lot of great, easy ways to do this. Seek out help from the credit union, talk through what you need done, and they can give you the right resources to help you do that. But improving and maintaining a score is really nothing more than just showing, hey, I'm trustworthy with the credit that I have, and I'm showing that I can repay it back over time. And as I mentioned, everything you do today is more important than what you did yesterday. So if you can start getting on the right track, if things haven't been as smooth as you'd hoped, get right back on track, and then just continue it over time, and your score will naturally improve, all else being equal. Some ways to protect your credit during COVID-19. I want to tie this in with some of what we just learned. Protecting your credit really is nothing more than doing what you would do normally with your credit over time. So first, continue making minimum monthly payments on your accounts. If you can do that, you're going to be just fine, right? So if your income allows you to do it, if your circumstances allow you to do it, continue making minimum monthly payments. Follow all the advice we just listed, right? Pay on time, keep your balances low, don't apply for too much. That'll help protect you during COVID-19. The other thing you can do is if you're having difficulty, if you're not able to make the payment, if you're not sure you're going to be able to pay on time or even pay the full amount, talk to your creditors, talk to your loan servicers right away. Ask for deferment or forbearance on those particular accounts. And this is where deferment, for example, temporarily suspends the payments for a period of time. Forbearance could reduce or suspend the payment. Interest may or may not be accumulating depending on what type of loan you have and the status, so be aware of that. But this allows you to get these statuses placed on the accounts, the deferment status or the forbearance status. Essentially just freezes, the status of that account where it's at, and then allows you to, again, for a period of time, reduce or suspend that payment. And then when that period is done, go back to making those payments again. So if you can put a status in place of the deferment or forbearance before you miss the payment, before you're unable to make the payment, that status will go onto your credit report, the deferment or forbearance status, but it won't hurt your credit report or hurt your score if that status is there. It's just saying, hey, this account is paused or the payment's been reduced or suspended for a period of time, and then you go back to the normal terms after that period is over. So if you can put that status on before you miss the payments, that's going to help you avoid any missed or late payments on the credit. Or let's say you get 30 days past due, then you call and get the deferment. Well, when that deferment's over, it's just going to show you're still 30 days past due, and you have to pick up where you left off on that particular account. So it's not going to make the situation any worse. Explore these options with your servicers or your creditors as soon as you know that you're not able to make a payment. That'll help minimize the impact to your credit, and then you can figure out a way to get things back on track after those statuses are over. So very simple, very easy to do. Just pick up the phone, ask for that help. And many creditors and many servicers have specific programs for people impacted by COVID-19, so they're very likely to be able to offer something to you very quickly and easily over the phone. Now, with all this information, I want to help us apply it, help us think through the logic of what we just discussed, right? I want you to think like a credit expert so that you can start to apply it to some scenarios that we have here, and then use that same logic to apply it to your scenario now or sometime in the future. So scenario number one, let's pretend you're a credit expert and someone comes to you and says, I don't think I need to check my credit report because I pay all my bills on time. What would you say to that person? You'd say, well, that's great, you're paying all your bills on time, but it's still important to check your credit report. Why? Well, make sure there's no identity theft or fraud that's occurring. Make sure that the information reporting is accurate so that there's not something inaccurate that could be impacting your score. So do continue to check your credit report regularly, at least once a year, to make sure you check those boxes. Even if you're paying on time, make sure that you're checking the report for accuracy and making sure there's no identity theft or fraud that's taking place. Scenario number 2, someone says, I should never close a credit card because it'll damage my credit. Now, this is a little bit more tricky. So when someone asks a question or makes a statement about credit, one of the things you can always respond with is, well, that depends, right? A lot's going to depend on what you're trying to say here with this scenario or this question. Can you close an account on your credit? Will it have an impact on your score? Will it damage your credit? Well, it's going to depend on what's going on with your credit report. So let's say someone has kind of a thin credit profile. They just have a couple accounts. They don't have the best payment history. They want to close an account. They close that account. That's going to impact the debt to credit ratio, that amount owed, that 30% on the FICO score. That's going to lower the available credit that's there, which could increase the ratio of what they owe across the board with the credit that they have. So that could actually damage their score if they close an account when there's situations where they have kind of a thinner profile or not as strong of a credit situation. So you would say in that scenario, don't close your account. Keep it open. Make sure if it has a positive payment history, make sure it stays positive. Use that to your advantage to continue to improve your credit. So you would say keep that account open. Someone else has a strong credit profile, a lot of credit cards, they have a mortgage, a car loan, maybe a student loan they've paid off, great credit score. They want to close one of their 6 credit cards that they have. Could they do it? In many cases, they probably could close it. It would have almost no impact or very minimal impact, and then their score just bounces right back up because they have such a strong credit profile, it doesn't really notice the closing of that particular account. So depending on the scenario that you have, depending on what your goals are, depending on all the various factors that are there, it could depend on whether this type of scenario, you should say, hey, don't close it because it could hurt you, or hey, if you want to, feel free, it's okay. But you have to know the other factors that are there, the other information that's there as well. So apply this to your situation specifically. I'd say in almost all scenarios, it never hurts just to keep an account open, right? Unless you're paying an annual fee and you don't want to pay it or something like that. If there's an account with a 0 balance, just keep it open. It's not going to hurt you to keep that particular account open as it comes to the area of credit scoring, right? So that's not going to be a factor at all. And then scenario 3, we've got 2 people, Maria and Andrew. We're going to pretend these 2 people have the exact same financial scenario, same income, same expenses, same items on their credit report. Exact same scenario except for this one credit card. Maria, she has a credit card with a $1,000 limit and a $900 balance. Andrew has a credit card with a $20,000 limit and a $10,000 balance. So exact same scenario except these 2 accounts. If I were to ask you who has a better credit score, what would you say? Well, we'll logic through what we know about credit scoring. One of the factors is debt to credit ratio. Who has the better debt to credit ratio? Well, it's Andrew. He has a 50% debt to credit ratio, whereas Maria has a 90% debt to credit ratio on this card. So who has a better credit score? When we're looking at just credit scoring, Andrew has a better credit score. That's great, right? Let's change the question to another question. Who is better off financially? So again, exact same financial picture except these two accounts. Well, who's better off with their personal finances overall? It's actually going to be Maria. Why? Because she owes a lot less debt on her account. So when we talk about credit scoring, a credit score, again, is just how you manage your credit and debt accounts. Are you paying on time? Are you paying what you owe? Are you paying down the balances? When it comes to your overall financial health, your financial capability, other factors come into play. Maria having less debt actually puts her in a better position than Andrew. So we have to separate financial wellness and financial health from credit score, but knowing how the credit score works helps us maximize that area of our finances. But then we also have to work on the personal finances, make sure we're budgeting well and saving well and managing our debt appropriately. So don't discount the importance of that when it comes to your overall financial situation and the goals that you have with your personal finances. Some takeaways for you. Number one, we've talked about the importance of paying on time and that being the most important factor in your credit score. Where you can, automate payments to make sure you do pay on time. So set up auto pay or bill pay through the credit union to pay on certain accounts. Make sure everything gets paid on time, and you don't have to think about it. Set it and forget it. Make sure things are paid on time and in full each month. That'll be a simple, easy way to accomplish that goal. Number two, create a reminder to check your credit report at least annually. So put it into your calendar, put it into your phone. Every year, go to annualcreditreport.com. Check all 3 of your credit reports, make sure you know what information is there, and you should be good to go in monitoring that. And it's kind of if you want to consider it, a free monitoring service. You're the monitor checking your credit report every year just to make sure all the information is accurate. And then number 3, don't overcomplicate credit. We talked about the tips for improving and maintaining a score. Once you know how credit scoring works, it's really simple. There are no secrets, there are no tricks. It's just doing the right things right and doing it consistently over time. So by teaching you this today, you're all set. You don't have to overcomplicate anything. Just take those tips, move forward with them, and you'll do just great. If you want to, you can utilize GreenPath as a partner of the credit union. We offer free financial assessments where we can actually review information from your TransUnion credit report for free. It's a soft pull of the information, and we can provide that to you and give information or send that information to you when we're done. It's not a full report, but we can get the creditor, balance, and payment of debts on the TransUnion report, talk through questions you might have about credit, talk about those particular accounts, and make sure you're maximizing your credit. We can provide this for free because of Park City Credit Union's support of GreenPath as a nonprofit. So we certainly appreciate that and take full advantage of that as a member of the credit union. Simply just call the number, let us know you're a member of Park City, and we can do that for you. If there are any questions, we can certainly answer those. Hopefully I've addressed many questions that you're maybe thinking about during the webinar already, and we can answer those. Something did come in through chat. Is it important to try and get a perfect 850 FICO score, or is a score in the 700s or low 800s okay? Great question. What I like to share is the story of when I read a newspaper article. And if I recall the headline, it said something to the effect of, man has nearly 1,500 credit cards and a near perfect credit score. And I had to chuckle at that headline thinking, he has over 1,000 credit cards, but he still doesn't have a perfect credit score. What can you do to get a perfect credit score? In reality, about 1% of the population has an 850 FICO score. So should we strive for an 850 score? If you want to, you can, but it's not necessary. If you're in low 700s and above, you're typically in the best tier when it comes to getting the best rates for loans and that sort of thing. So if you're in the low 700s and higher, you really don't have to strive to get a perfect credit score. Just maintain that and you'll do just fine. So maximize the score that you have. If you want to be perfect, that's great, but you don't have to be perfect when it comes to a credit score. Low 700s, 800s, you're doing just fine, and you'll get the best rates when you apply for something. Good question. Good.
Awesome.
And then if there are any other questions that come in, I'll address those, but feel free to, again, utilize GreenPath for the free credit report review. Check out the credit union website for their credit rebuilder loan and other services that can help you manage and improve your credit. And then I'll throw it back to you, Sarah, for any closing comments.
Yeah, thank you so much, Luke. That was really great information, very thorough. I was trying to think of some questions on my own, too, and I'm like, you're just hitting everything. So, again, we appreciate this is the second seminar you've had this week, and we're very appreciative of all the information that you bring to the table. Very helpful information. If you think of any questions after watching this, maybe you're watching a recorded session, you can always reach out to marketing@parkcitycu.org as well. Send it our way. We can always send Luke an email or give him a call and have him reach out to you or get back to us with that answer. So feel free if you have any questions, if you don't have any now, or maybe you watched a recorded session, to let us know if you have any questions. But otherwise, Luke did just a phenomenal job, as always, giving us some great information. So with that, on behalf of the planning team and presenters, I want to thank you for being a part of our second annual Northwoods Financial Summit. And as a reminder, we will send out the recordings of the sessions next week, as well as a survey for feedback. And if you've gained some new information, you can still register today to get a recordings of the session, or just send an email to marketing@parkcitycu.org. We'd be happy to get you signed up to receive those recordings then. So again, thank you for attending, and have a great day and great weekend. It's Friday, everyone. So we'll hopefully be able to have some more sessions in the future, so stay tuned. But thank you, everyone, for taking a part in our second annual Northwoods Financial Summit.